So I'm back with another video, and today I'm going to be introducing you to Beat the Market Maker method. So I'll show you how the market is manipulated and who does it and when is it manipulated. Okay, so this course is made by Steve Mauro and my presentation is based on his work, and this is for education purpose only, not as a trading advice. Okay, so this is one of my best setups. It's my go-to setups. So let's get started. Okay, so who are market makers? The market maker is a group of institutions with huge equity base and have influence on the media and politicians. Okay, so those who have been trading lately, you can see how the market has been manipulated. So mostly with the war in Iran, you can see how on Friday they will say one thing, but on Saturday after the market is closed, then they will say another thing, and on Monday they hit stop losses, okay, with a gap. So that's how they manipulate the market. So if you see things like how Trump has been posting things, it's not a random thing, as you can see. If you look at the charts, he'll only post something just the moment when market makers are about to move the market. Okay, yeah, if you just go and Google, you'll see there is some investigation going on due to insider trading and things like that. Okay, so let's continue. So price is a byproduct. Okay, price simply reflects the real transactions made by institutions and the market makers. So the work of a market maker is not actually to trade. His work is actually to take the other side of your order. Okay, so he's the liquidity provider in the market. So when you sell, he's the guy he's buying from you, and when you buy, he's the guy selling to you. Okay, so as you can see, so the market has really increased the volume. Before, the market was moving around 7.5 trillion in a day. Right now it's moving 9.6 trillion in a day. So this is something you can go and search on Google. There is more to that. Okay, so do you know you actually need 10,000 standard lots to move the market 1 pip? 10,000 standard lots just to move the market 1 pip. So you imagine how much it will cost to move the market 100 pips. Okay, so if this is 10,000 lots, then you can times 100, then you see how much crazy money you need to move the market. So this basically a retailer cannot do. So we don't have that. So we don't predict market, we only trade the reaction. Okay, so let's continue. So these are the guys. So we have the New York Stock Exchange. These are the guys that control the New York session. And we have Citadel. Citadel is a very huge institution. They also take the other side of your orders. So these guys are the liquidity providers. And we also have high frequency traders. So these are the guys, those who know about spoofing, mostly is done by these guys because they are using very high frequency trader. These things can place a trade and cancel it within milliseconds. Okay, you can go search more about high frequency traders. I'm not going to get into that today. I'm just going to introduce you to the basics of the market makers. Okay, so these are things you can get online. So you can go do more research about this. There is a lot of documentaries on YouTube about high frequency traders and everything else. Also Citadel has done some of that. So you can see how market makers do their work. So the London Stock Exchange, so this is where they control the London session from. So this actually is where we get most of the volume on trading. Okay, the reason why you'll see Actually, London is more calm because has a lot of volume. The New York is usually more a bit aggressive. The reason is a bit aggressive. The future markets opens the same time as the New York on the New York session, so that's why this gets a bit aggressive. Okay, so those things that are tied to futures, and mostly things like gold, you'll find them moving more on the New York than they do on London. So the pairs are the one that actually moves more on London, and the pairs that move on London are the one based in London, mostly like the GU, Euro, and such kind of things. So UBS, so this is a monster room in UBS. Actually, UBS, I think they are the guys with the biggest trading floor. So you can see how many people are there. So these are the guys taking the other side of your trade. So before placing a trade, have this picture in mind. Okay, so these are the guys on the other side. You can also search more about UBS. You'll get them. Okay, so why price is not random? Okay, so most people think price is just random, is moving based on buyers, sellers fighting and things like that, but actually it's not really like that. So what happens? So let me ask you something. If you are the market makers taking both sides of the orders, you are taking buys and you're taking sells, and you have all the money in the world to move the market, so wouldn't you rig the market? So that answers exactly why the price is not random. If I was the one moving the market, I definitely would rig it against retailers, and I'd also make money. So remember, when they are doing that, they are taking buys and sells, they make money doing that. That's why we pay spread. So that's the cost of business. Okay, so these are the three phases of the market. So this is the cycle that happens every day. This cycle has to happen, but they do change the times. So this is I've given an example based on a perfect timing, but most of the times they will change the timings to confuse people, because if they did it exactly at the same time, most people will find out and they'll incur a lot of losses. Okay, so these are one of the biggest tool market makers have against us is time. Time is a very, 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 very huge tool. Let me give you an example. So if you take a trade, let's say in Asia, remember market makers work in sessions and they are controlling it in different sessions. So the market maker that is controlling Asia is not the market maker that will control London, and is not the market maker that will control New York. So you have three desks, okay, working on this. So as a trader, you own yourself. So if you took a trade in Asia and it does not move, you're praying -5 +5 like that. So this is a psychological torture to you. So they use that time to make you get frustrated, and you end up clicking out of the trade. And the moment you click out, you'll find out they'll move. I don't know if you have experienced this. Okay, so sometimes you'll feel like they are targeting you, but actually they are not targeting you. They are targeting us retailers as a group. Remember, humans behave the same when money is involved. There is fear and there is greed. So if I'm taking both sides of the trades, I have buyers and I have sellers, I can see the volume. I can see which side is the market leaning as retailers and which side I'm leaning. Remember, when retailers are long, the market makers are short. Why? Because they are the ones taking the other side of the order. So if the market is long, we have more buyers than sellers. Remember, the market makers, they are leaning the other side, and just know they are not going to give you money. So definitely move the market based on the side they are leaning on. Okay, so in BTMM we trade the behavior at a particular time. So this is very, very, very important. Behavior at a particular time. So the market is rigged, but it's not rigged at all times. It's only rigged at specific times. Okay, so this is, let's start. So accumulation, this is on Asian session, is usually a very calm. So most people, if you have a bot, those who trade resistance and supports, very high frequency traders, will definitely see them trading on Asia because they don't expect to have very, very huge movements. So they are scrapping. Okay, they are scalpers. Okay, so the ideal range for Asia should be less than 50 pips. If the Asia is more than 50 pips, that's a brown out Asia session. Okay, so when it's more than 50 pips, we trade it differently, but when we get there, I'll teach you how to do that. So for now, I want you to only consider Asian session less than 50 pips. Okay, so down here you can see the range. So here we have 20.6 pips for the range. You can see they were just moving down, up, down, up, down, up, creating the initial high and then the initial low. So when the market opens, they create a high and create a low, and they do not break it, okay, until the Asian session is over. So that's the accumulation phase. Then we go to the manipulation phase. Remember, there are some people trading resistance and supports. So how do they do it? They'll put a buy stop just above the Asian session and a sell stop just below the Asian session, and the market makers know this. So what will they do? They'll trigger those buy stops and trigger sell stops at the same times and then kill those guys. Okay, so this is what they'll do. So remember, most people who don't know about the sessions, the Asian and how they're manipulated, they'll probably be putting sells here, putting buys, putting sells, putting buys, putting sells, buys, and then you can see here. So when the market comes here, they put a sell and expect it to come down, but it does not. Okay, so those who put buy stops right here, they'll be triggered by this. If they don't get them all, they'll try and catch all of them, and the moment they get enough orders, you can see they'll pull back crazily and stop those guys out. Okay, and those who will enter sells here, they'll also be killed. You can see, so this is how they manipulate. The actual manipulation is just an extension of the Asian high or the Asian low. So how do they extend it? They extend it in 3 candles or 3 moves or one very huge move, but when you look it from, it will have 3 impulses. Okay, it will be moving up, then staying there, then move up again, staying there, then move up again. But when you look at it, it will be a 1 candle. But the perfect setup will have 3 candles. So these are perfect example. So you can see, actually here they didn't actually really break it, they were just tweaking it, and then the actual break happens here. So those who have had or have seen Steve videos, you know about the Brinks trade or have had it. So the Brinks trade is a trade that happens at 3:45 a.m. New York time, and here is the candle. You can see the 3:45 candle here, and the moment that candle crosses, we get our vector. So vector is just an extension of the high in this case in 3 impulse moves. See 1, that's a 1 impulse move, 2, and then the 3rd impulse move that got rejected and gave us a hammer. Okay, when they do this, now you know you are looking at the high of the day, and so you observe the behavior, and you should be looking to sell here. So this is the manipulation phase, the distribution phase. So this is where they have manipulated the Asia. They have already extended the initial high. Now we have the high of the day. So they'll trade away from the high. They'll never ever go back there. if they have enough money. The only reason they will go back there is up there is a lot of stops they need to hit, or they require more money to go down. Okay, remember, market makers will only move the price if it will benefit them or they'll make a profit. Okay, so this is the distribution phase. You can see they faked buys, kept faking buys, and then drop like crazy. You can see the very first hit, they hit the Asian low. Why? They want to trigger those guys who put sell stops here. So they want to take those sell stops, since those guys will be correct. If the market continues, they'll make money. They don't want to give them that money, so they'll just pick them and drag them back and hit their stop losses, and then now continue on the direction they intended. So if you took sells here and took buys here, you got killed either way. Okay, so you should know where to trade based on the exact times. So these are the times the market is rigged. Why do they rig the market here? We have a lot of volume coming, so they wanna fake and induce that volume to go on a certain direction. Okay, so when you wake up and you are a London trader and you see the market is moving up, most people trade resistance and supports. So they'll see this resistance has been breaked and they will take buys as breakouts. Okay, so that's what they are trying to induce. So remember, when you take buys and there are more buyers, the market maker is sell side and he wants to make money, and the only way he can make money is taking the market down. So he needs more people to go buys for him to take the market on the sell side. So remember, this is done by different banks. We have a lot, it's a huge group that does this, so they communicate and they know exactly where to take the market. Okay, so let's continue. So these are the timings, the 3 trading sessions. So these are the actual timing based on New York time. So the Asia will open at 5 p.m. will close at 5 p.m. and open at 5:01 and end at 12. Okay, so you can watch my latest video, that my previous video I mean, and I have explained how to get the actual time based on the broker you are using. Okay, so I'll not go deeper into this today because I've already covered this, so go watch my previous video. Okay, so here we have a gap time. Most people don't consider this gap time. Okay, remember, market makers are managing based on different desks. The market maker managing Asia is not the market maker that will manage London. Why? In Asia, for the market to open and close, that's the time. Let's say it's 8 or 9 a.m. in Asia, and then when the market closes, it's 5. So these guys are white collar jobs. Okay, so they'll work from 9 to 5. So this guy will work from 9 to 5. On this gap time, he will communicate with the London guy who comes on the London desk. I mean, it's not one person doing this, is a full trading floor. So they'll communicate, they have tools to do this, they'll know what this guy did. So we have gap time that will take around 30 minutes to 1 hour for them to do all that, and then the London guy takes over. It will be now around 9 to 5, and then the New York guy will have woken up and he will be in his office by 9. So they will communicate with the London guy and he'll tell him or show him what is going on. Then the New York guy will take over. So we actually have these gap times. Okay, so this is where the rigging actually happen most of the time. Okay, so let's continue. So the anatomy of Asian range and how they do the stop hands. When Asia forms, this is where most of the times and most pair will give you the range, unless they are pairs based in Asia like the Japanese yen. mostly Japanese yen will move in this area and will consolidate in London, but the other pairs mostly will consolidate in Asia and move in London. Sometimes gold moves in Asia, consolidate in London, and will move in New York. Okay, so the Asian range, we have the initial high of the day and the initial low of the day. So this is where the market maker makes his spread for the day. This is where he's trapping people buy, sell. He's just correcting spreads at this time. He's just letting the market move, but he has orders above to where he will not allow the market to pass in another order down, and he will not. Let's assume this an order broke here. So he has broke this place, he'll not allow market to go above that, and he broke this place, he'll not allow the market to go below here. So you can only trade in here as a retailer. So you'll trade. The range is usually around 50 pips. That's the ideal range. Okay, they'll trade around 50 pips, consolidate. Once the Asia is done, he'll look at his book and see which side the retailers are leaning on, if he has more buyers and or more sellers, and so he'll induce the market based on that. Okay, so the stop hands are usually an extension of Asian range. Okay, why do they have to stop hands? Remember that when Asia was forming, there were people taking sells here, other taking buys here, so they want to trigger those stops out. And also there are people who are waiting for breakout of Asia to continue with the price on that direction. So the stop hunt will happen around 25 to 50 pips. So this is the ideal stop hunt, but most of it depends on the pair. For GBPs, they might hit 50. For pair like Euro, mostly they'll play around 25 and things like that. If you see Euro give you a stop hunt of around 50 pips and they give you an M, I'll show you an example right here. That's a trade you should put a huge lot. Okay, so let me show you. So now, after having the true H of D and or the low of the day, now they'll move the market on the direction they were intending to move all along. Okay, yeah, let me show you. So this is a trade I took on Monday. So you can see this was 13th July 2026. So this is a trade I actually took. So this is what happened. They opened, they formed the high and the low of the day, so they were just playing around here. So this is where they put a huge order, and here we have a very huge order. Okay, so if you have a book map, those who know about book map, you can be able to see those orders, but you'll have to pay for it. You can also, those who have thing called Swim, I think they also provide this. They also provide the book map. You can see book map and thing called Swim. Or Ninja Trader. I think Ninja Trader also has this, but they are paid options. Okay, so this is what actually happened. So he'll set the initial high of the day and the initial low of the day. So they'll not break this until Asian session is done. Okay, on the last quarter of the session, they will lean towards one direction. So you can see on this side, they are leaning towards buy side. Okay, and they are avoiding sell side. Okay, so they'll move the market up. Remember, there were people who were putting buy stops here and sell. If you took a sell here, your stop loss is somewhere above here. And if you expect the market to go up, you'll put a buy stop here. So they'll trigger those buy stops and drag them and hit their stop losses. And they'll also hit stop losses for those who sold. So they are killing two birds with one stone by doing this. So they'll pull it until those guys who had put buy stops, their stop losses are triggered, and then they'll move the market crazy. So this is how they extend the Asian high. Don't get confused by this retro move here and think this is the high. Remember, there are those guys trading, I don't know how they call this strategy, that they wait for the Asia for the liquidity of Asia to be taken out, and then they'd go sells here. Okay, if you go sells here, they are definitely going to kill you. See, if you took sales here, no matter where you put your stop loss, they got it. Okay, I don't know how this strategy is called. If you know it, you can comment down on the comment section. So if you have ever taken this trade sales here and they hit your stop loss, this is what happened. Okay, so on this move up here, remember when you can see where they'll move it. This is the London Open. Okay, this is the gap time I was talking about. So on the gap time, remember now when London has opened, there is a lot of orders coming in the market. Okay, if you want to see how the orders appear, go watch Citadel documentary on YouTube. They'll show you how the orders come in the market. Okay, so they'll induce buys to fake more people to continue buying. Remember, why do they use 3 moves? Or why is the market based on 3 sessions, 3 vectors, 3 what, 3 levels? Why is that? Our brain, the human brain, works in, if it see something happen 3 times, it tends to believe it. This is biology, so it's something engraved in us. Okay, it's not something that you can change. So they play with our psychology. Remember, when the money is involved, you have greed and you have fear, and psychologists still they use those things to take the money from you. So when they move up, so most people will see a breakout from here. So remember, this was yesterday's low, so they'll break above that. Most people will take buys from here. Okay, they'll get some money, continue putting buys. And when this hits, most people will realize we are trending up. Those who use EMS for direction, or those robots that use EMS for direction, will have, the moment this goes up like this, they'll trigger buys, and so most of the market will be buy side. Okay, so when retailers are buy side, remember the market maker is taking the other side of the trade, so he is sell side. Okay, by the time he gets up here, he is heavy sell side, and the market is very heavily buy side. Okay, remember, it takes 10,000 pips to move the market 10,000 standard lots to move the market 1 pip. So you can imagine, if this move is 50 pips, you can imagine how many lots the market maker is leaning sell side. Okay, so now this is where you get to have the actual high of the day. How do you know the actual high of the day? Vector. So 1, 2, 3. So the moment that these 3 candles form, so these candles, the moment they form, if you are observing them, they have speed and they are very aggressive. Okay, they'll move very fast and they'll move. You see the market flashing blue, red. They are just moving. Okay, they are crazy. If you just them, you'll notice. Other characteristic of vector is color. They have the same color. Okay, you can see they are very huge candles, they move fast, and they are the same color. So in this case, they are green. Okay, very huge candles compared to this. You can see here we had very tiny candles, and then out of nowhere, boom. And those who don't know about this will go crazy on buys. We'll see the market is leaving, and then they start entering buys here, buy, chasing the market. Okay, some of them will see, they'll wait for this to cross, and then now they'll confirm buys, and then they start going long. Okay, those traders who are a bit skeptical, they'll wait for market to retrace, and then now they'll start going buys. So what does the dealer do? He'll give you exactly that. They'll do a retracement and they'll show you buys, and most people click buys, they snatch them back. They come down and fake another. So you think this was just a breakout? You think this is just a retracement, and then they'll continue with the trend up. So most people will go buys, and the market makers will lean more on sales, and then he will snatch everyone out. Okay. I'm sorry about that. Let me go back to that template. So here we were. So what I'll teach you is where to get in after seeing this. Okay. So when you get advanced, when you understand BTMM well, this is where you'll be taking your sales. Why here? See, these are buy, down, up, down. So this forms an M on a 5-minute time frame. If you go to 5-minute time frame, you'll see a very beautiful M. So for pro traders or advanced traders, you'll be taking your sales here. But at this level, I want you to take it here. Why here? So how does an M form? We use the 13 EMA to identify an M. Remember, an M moves up, down, up, down. Okay, so this is the first leg of the M, and then it will drop up to here. So most people might think this is the actual M up to here. They might think this is the second leg. Not yet. It's not a confirmed M. Why? Remember, the first leg has to first go below the 13 EMA. And where does it actually go below the 13 EMA? This is where it actually goes below the 13 EMA. So all of this is one first leg. This is not the second leg. All of this is first leg up to here. So this is the nadir for the M, the lower part of the M. Most people will call it the neck. Okay, the neckline. So all of this is first leg. Remember, they have to go, they are above the 13 EMA, they have to go below the 13 EMA, go back above the 13 EMA. After going back above, they have to come back below. The moment they give you back below, you can enter here, and they have to give you a nameable candle pattern based on BTMM. So this is a railway track. Okay. So the second leg, nameable candle pattern, is where you go sales on. Okay, so this is a nameable candle pattern, a railway track. Most of you will call it engulfing candle, something like that. Okay, but we call them here railway tracks because they look like the railway tracks of a train. Okay, so this is the first leg all the way down here, and then the second leg. We confirm them using the 13 EMA. Don't get confused by this. You think you have the second leg. The reason I'm saying you have to wait for the 13 EMA cross below, cross above, and then cross back below, because you don't know if the second leg will actually go above the high. Why? They might go above here. If most people click sales here and they realize they have a lot of stop up here, they have a lot of stop process up here, they will go and take that money and then drop. And when the second leg is higher than the first leg, that trade gets to be very, very, very aggressive, because now they have killed everyone who took sales and they have killed everyone who went buys, and now they are leaning way more on sell side. Okay, so they'll have to drop the market crazy. So on this case, after this, the moment you took it, this is the 945 candle that Steve talks about. These are Brinks trade. You can also enter here after the Brinks trade candle. So this setup is a Brinks trade, and Steve says once you see a Brinks trade, add that lot size. Okay, so it dropped nicely. Your first target is the initial low of the day, so that's where you should have taken your first take profits. Okay, or wait for your 50 to get hit. Okay, so let's continue. So the M's, how to actually get the M. So this is what I was talking about. The market is below, it goes above. Okay, is above the 13 EMA, comes back below the 13 EMA. This is where we get the nadir or the neck of the M. Has to go back above, and then you can see just on the time, the 9:45 candle, they give you a railway track. Okay, so you can take it right here, sells, or wait for it to close below the 13 EMA. This is where I want you to get in at this level. I want you to take confirmed M's and W's. You wait for close above, close back below, close back above. You have to see an M candle pattern based on Btmm, and then wait for a close back below. You take sells here, your stop loss can go just above here, okay, and they will never touch it, and then you can see the market disappears. Okay, so the same case with the W. So the market is below the 13 EMA, they go back above. Don't get confused by this small. Okay, so this is okay. Can you see the difference between this? So this is just a fake out. Okay, so if you think this is a cross below, cross back above, and you go buys here, they will kid you. Okay, you have to see a separation. You can see here the separation. The Steve calls this the V, calls this the A frame and the V. Okay, you have to see some separation here. Okay, for you to identify this, you can use a line chart. So a line chart will draw you very nice M, and when the line chart crosses above the 13 EMA, you can take it. The line chart is a very nice tool to help you with the M's and W's. So let me show the actual M. So this is the cross above the 13 EMA, the actual cross above. You can see the cross back below, the induced shorts. We have a cord of wood right here. We have a cord of wood. This is a very nice candle pattern, and then they crossed above. You can take your bias right here. Okay, you see they faked more cells and then came right above. Okay, so this might be an add-on. If you took a buy here and they do this, you can put more buys right here, and this trade went up like crazy. Okay, you can go check this was on GU some days back. You'll see this trade, they went up like crazy. Okay, so don't get confused by this small. You have to see separation here like this. You can see the gap in here and you can see the gap in here. So don't get confused by this small. It just gone back, but you can see it went right above. So don't think this is the actual W. No, it's not yet. This is the actual W. Okay, you have to have some separation in here. Okay, remember these are trap patterns, so they are trapping both sides. So you also wait for this. You have a gap here, you have an A frame, something that forms like a letter A. Okay, so that's the A frame, and for sales you have a V frame. When they want to sell, they'll give you a V, and when they want you to buy, they'll give you an A frame. Okay, so what are the tools that the market makers and the dealers have? First tool is capital. They have a lot of money. Remember, it takes 10,000 lots to move the market 1 pip. So these guys have trillions of dollars in their accounts. Okay, so that's their biggest tool. They know where most stops are. Definitely they know where the stops are. How do they know? If I'm taking both sides of the market, okay, I know at a particular price that's where most people went sells. Okay, so if let's say at this point the market, most of the retail traders went sell side here, so their stops must be somewhere above here. So if I want to get all these stops, what do? I just push the market just above here, around 25-50 pips, and I'll have all these guys stops. So that's how they know where your stops are. Okay, they can move price fast, then trade the reaction. They are able to to trade dealer to dealer, market maker to market maker to induce people. Okay, remember this will cost them nothing because they are the ones charging spread. So the only thing they have to do is commit capital, but it doesn't cost them a dime. Okay, they don't have to pay. They are the market makers. We are the one paying them through the spreads and things like that. Okay, it's called the cost of business. So they don't have any obligation to trade fairly. Their only goal is profits. Okay, but remember, they cannot move the market a million pips or what. They will destroy the economy. Remember, the forex market controls imports and exports, so they cannot move the market crazily. Okay, so the dealers and the brokers, so they have aggregates and roads, grants, order flow. Remember, your broker has two books. Okay, almost every broker has this. The first book, that's for profitable traders. Okay, the second book are traders who are losing. So let me ask you a question. If you are a broker and 80% of your clients are losers, they lose money, what would you do? Won't you take the other side of their trades and become 80% winner? That gives you instant 80% strategy to win. Okay, so if 80% of traders are going to lose, I'll definitely take the other side of their trades, and when they lose, I take the money and keep it for myself. So they have two books. So if you are a profitable trader, just know you are in the A book, and that's the book they submit to the market makers. And if you are losers, they will definitely take the other side of your trade. Okay, so they'll set the bid and ask and spreads on clients. So you see, this is a problem with some brokers. You see some brokers have very, very, very huge spreads, and they will manipulate the spreads to take the money from the clients. Okay, you can see they will hedge its own exposure against clients' positions. This is what I was talking about. If 80% of the traders are losing, I'll definitely take the other side of their position and become 80% winner. Okay, so they are providing you the platform to execute. Okay, so if the platform you're using, they are the one providing you, they definitely can also control it. This one, how some of the times they will control it, the platform. I don't know if you have ever been sitting on MT4 or MT5 when there is news. You'll see it hang the moment news trigger. Okay, it will hang. How does this help the dealer? Remember, if you are trading without a stop and you are waiting, if the market goes wrongly, you'll click out. And the platform hangs. You can't click out. Okay, they will not allow you to click out, so they'll just take your money. So that's how they manipulate the platform. Other thing is the scale. Okay, scale is a very huge manipulation tool. So the scale will make the candles look bigger than they actually are. If you count the pips on the candle, you see a 10 pip candle looking very huge. Okay, so that might fake you to go on that direction. So they use scale to induce people too. Most people don't really take note of the scale. Okay, so one tool we have in Btmm is to make sure the scale is correct. Okay, and you'll see some tools in Btmm that will help you to manage the scale. Okay, so let's continue. So these are the terms we use in Btmm. The ADR, this is the average daily range a pair has to move. Each pair has an average daily range. Remember, the market makers are controlled. Okay, they are regulated by the World Bank and the IMF and all that. All the regulatory bodies in each country. In those very big countries, they have to regulate them. Why do they regulate them? Remember, let's say you are in the US and they are trading the dollar. If they are not regulated, they might destroy the US economy. They might drop the dollar or drop the the GBP, and they might destroy the London economy. So they have to be regulated to how many pips they can move in a day. Okay, so that's why we have the ADR. They will extend the ADR, but they have to cross below the ADR by the end of the day. So this doesn't mean if the ADR is 10 p is 100 pip, they will not pass the 100 pip. They will, but the moment the ADR is passed, then for us as BTM, we know now here we have to go the other side, because the market maker has to go back inside the ADR for the day. He must cross below the ADR. If he goes above that, he will have some problems with his bosses. Okay, so book a profit, that's just taking profits. Brings trade, these are trade that sets up at a specific time. This is usually 3:45 and 9:45 candles. We have the spike candles. Those are the candles that will spike up then close below very fast. Consolidation is just Asian session. Correction, a pullback. So the cross pair, these are currency pairs. So let's say GBP USD, we have cross pairs like GJ, something like that. So the bidder spread, this is the bid and ask, the cost of doing business. Okay, so extended stop hands. So an extended stop hand is usually around 25 to 50 pips range. So this is what I was talking about. So the gap time, those are the times between the sessions. High and low board. So the high and low board, this is where you'll get to see the high of the day or the low of the day. Okay, so there is an exercise that Steve teaches, and I will also teach you when we get to that, about the high-low board, how to identify the high of the day and how to grab the high of the day. Okay, so we have the high-low marker. So this is an indicator that will, the blue tracer that will trade yesterday's high, yesterday's low on the next day, because we have some orders sitting there. Okay, so the high and the low, this basically the high of the day, low of the day. Holding a level, this just consolidation. ILO, IHOD, ILOD, this basically the initial high of the day, initial low of the day. Long positions, just that buy M top, this is an M pattern. Market maker, you know who they are by now, and they are spread the distance between the initial high of the day and the initial low of the day. So this is the market maker spread. The Asian session is the market maker spread. Okay, so we have market maker trend. This is the real trend for the markets. Okay, market sentiments, presence mood not grounded in a fact. So sentiments is just showing you which side the market is leaning on, either the retail or the dealer. Okay, mostly the retailers. Okay, net change, this is the difference between the open and the closing price of a pair. That's the net change for the day. Okay, I don't know if you've ever seen a pair move. On Monday it opens and then move crazy 200 300 pips, and then by Friday it closes exactly where it opened. So we have zero net change. They killed up everybody, but the pair had zero net change for the week. Okay, so on the board, this is the running position. Open flow, that's your equity. Peak formation, this is the highest point of intraday or intra-week. Okay, reset or trend reset, this just if the pullback and reset the price. When you get to this, I'll explain more about resets. Okay, rise, this just going up. Scratch, this is crossing on break even. Sessions, you know what they are. Shift bars, this is the bar that moves. It's usually 10, 15 to 20 pips based on the pair. This is the bar that they run away from the high of the day or the low of the day. They'll move it and get the hair out of there. Okay, short position, that's just a sell. Stop hand, this is hitting stops straight away. This is a pair that this is a trade that gets out of Asia and runs away. Okay, it doesn't give you an entry for this, so we don't trade straight away. Okay, so swap premiums. So these are just interest charged for holding a trade overnight. The TDI, this is a traders dynamic indicator. We use this in Btmm a lot. I'll teach this when we get there. So time mapping, this is the broker server time. I taught this on my previous video, how to time map your broker and know the exact times you should be using. Okay, trending zone, this usually after they hit the stop process, so that's your trading zone. Okay, it's usually 16 pips, 16 bars from the close of Asia. I taught this on my previous video, make sure you watch that. Okay, so the trend is the run for the day, the V top or the V bottom. This usually happens on the second day and the third day. I'll teach this when we get there. Okay, on the weekly cycle. So the vector, these two are those moves, crazy move. This is the extend the initial high of the day. So the W button is just the W. Okay, so take these notes and master all these terms, because this is what we will be using in Btmm. Okay, so these are the Btmm candles. So these are the candles you should see on your second leg before taking that trade. Okay, so we have a hammer, evening star, the railway track, shooting star, spinning top, morning star, doji, we have inverted hammer and railway tracks. Okay, we also have another one called the cord of wood. The cord of wood are just two railway tracks stuck together. Okay, so you can see the railway track like this one. Okay, red green, that's a railway track, red green, so they are just two railway tracks stuck together. When you see this, it's a very powerful candle pattern. Okay, you make sure you just enter buys right here. So which direction do we take on these ones? Let's say this will form on a W. So for a W, you'll have red green, so you take buys. For a sell, you'll have green red, and you'll take your sells right there. Okay, so another very strong candle pattern is the half a Batman. It looks like Batman cut in half. So you see, very aggressive. This is the vector, very aggressive, and then they pull back, and then they'll have that. If you draw eyes here, he looks like Batman. Okay, so where do you get in on this? You enter based on the M, how I've taught you to enter M's. So you have to wait for a cross below, back above, back below, so you enter right here. Okay, for those who like very confirmed M's or patterns, you'll wait for it to cross, to break this point. This is the lowest point. You might wait for them to break that, a retest into it, you go sells right there. Okay, and you see how crazy they drops. So that's basically it for today. So next time I'll be teaching more. I'll be adding on to this, so make sure you watch my next video. So see you on my next video. Bye bye.